Welcome to the Shareholder Brief. I'm your host Sunil Joshi, and each weekday I'll walk you through the corporate developments that actually matter to individual investors. In 10 focus minutes, we will cover a handful of US, European, and Asian companies with respect to their earnings, regulatory decisions, strategic shifts, and capital allocation, with emphasis on what changed and why it matters to the shareholders. This is a daily corporate briefing designed to help you think clearly before the next trading day begins. Today, we will be reviewing 6 companies that have been in the news recently: Microsoft, Salesforce, Eli Lilly, Sanofi, Novo Nordisk, and Tencent. These companies were all in the news last week, and their stock has seen significant movement up or down. So let's start with our first company, Microsoft. Over the last month, Microsoft's stock has declined 12%, and people are wondering what is going on with this important component of Mag 7. Today, Microsoft trades at about 25 to 30 times forward earnings. The revenue is growing, although low double digits. The operating margins are in the mid 40s and growing. Their free cash flow margin is in high 30s, but fluctuating due to heavy AI investments. The one thing that has raised investor concerns recently is the rising AI capex and moderation in the Azure growth. At 30 times earnings, Microsoft is priced for durable double digit growth, stable incremental margins, and high return on capital. If Azure growth slips towards high single digits while capex remains elevated, even a 2 to 3 point compression in operating margin could reduce the EPS trajectory materially. But if growth reaccelerates and AI revenue scales efficiently, the premium multiple will remain defensible. So Microsoft is a capital investment intensity story versus margin durability story. Our second company today is Salesforce. CRM has declined 17% over the last month and around 22% over the last 6 months. Today, CRM trades at 14 to 16 times forward earnings, and their revenue growth is in the range of 9 to 10% range. Their operating margin, the GAAP margin, is around 20% and is consistently improving. They have strong free cash flow conversion, and the company is guiding at 13 to 14% free cash flow conversion. The main catalyst for Salesforce is going to be margin expansion, but the stock is encumbered by slower top line growth. At nearly 25 times earnings, the stock still embeds growth optionality. If revenue settles at 5 to 6%, a multiple closer to mature software peers, which is in low 20s, could be justified. If AI drives acceleration back towards high single digit, its multiple could go back to 25 to 30x range. This is the growth re-acceleration versus cash yield re-rating story. The next company in our snapshot is Eli Lilly. Eli Lilly trades at 30 to 45 times forward earnings, and the company is projecting revenue growth of 20% plus in the near term. With non-GAAP operating margins of around 47%, the margins are continuing to expand. Lilly stock has been range bound recently between 1,000 and 1,100 in spite of GLP-1 demand and manufacturing expansion. At 45 times earnings, the market is assuming a multi-year high teens earning growth, sustained pricing power, minimal competitive erosion. If price normalizes faster than expected, according to the analyst, reducing long-term growth expectations from 18 to 14% dramatically lowers discounted cash flow implied value, and that could affect the stock price. On the other hand, if reimbursement for GLP-1 expands and global penetration accelerates, peak earnings estimates could move higher. So Eli Lilly is a duration of growth and peak margin sensitivity story. Our next stock is the competitor to Eli Lilly, Novo Nordisk. Novo has seen considerable volatility with a 1-month decline of around 13%. The forward PE has contracted significantly and now is at 13 to 15%. After a strong revenue growth in 2025, Novo has forecast a revenue decline of 5 to 13%. Now, on the positive side, despite pricing pressures, Novo is managing industry leading gross margins of around 80%. So, the main catalyst for Novo is going to be competitive tension versus Eli Lilly and supply dynamics, particularly in the big market of US. If the competitive share stabilizes and obesity market expands, earnings multiple could rise again to 30s. But if the pricing pressure rises in Europe, long-term margin expectations fall, multiple will stay low and potentially compresses even further. The sensitivity here is competitive positioning. Our fifth company is Sanofi. Sanofi has been trading at 10 to 15 times forward earnings. For 2026, their revenue growth is forecasted to be high single digits, and margins are under pressure due to heavier investment in R&D to build a pipeline. The catalyst for Sanofi is going to be strategic refocus and pipeline dependence. Sanofi trades at a discount relative to its peers. If pipeline execution improves, multiple could re-rate towards large cap pharma averages of about 18 to 20 times forward earnings. However, if Dupixent concentration increases without diversification, the stock will likely trade at a discount. So, this is really a credibility and execution re rating story. Our final company today is Tencent. Tencent ADRs in the US have seen a 10% decline over the last 6 months, and Tencent trades at 15 to 20 times forward earnings. Revenue growth is high single digit and they have a strong net cash position. Its main catalyst is regulatory normalization. Due to regulatory uncertainty, Tencent trades at a discount to US mega cap tech stocks. If regulatory risk declines, even a modest multiple expansion from 18 to 20x could drive meaningful upside without any earnings acceleration. But if policy unpredictability returns, the discount will remain. Here, the valuation is driven more by risk premium than operating growth. This concludes today's Daily Shareholder Brief. This program is for informational purposes only and is not an investment advice. Always do your own research and consider your individual financial situation before making decisions. Join us tomorrow morning for another structured look at the companies shaping global markets.